Not sure whether to invest in stocks or bonds? Let's break it down in plain English with real examples to show how each one works. Welcome. In this video, we're diving into the world of stocks and bonds. We'll cover the key differences between them, how they typically perform, when you might consider using each one in your investment strategy. By the end, you'll have a clearer picture of how to build a balanced portfolio. First up, stocks. What exactly is a stock? Think of it as ownership in a company. When you buy a share of stock, you're buying a tiny piece of that business. For example, let's say you buy Apple stock. You now own a small portion of Apple. As a shareholder, you can potentially profit in two ways. One, through the company's growth. If Apple does well and its stock price goes up, you can sell your shares for a profit. And two, some companies like Apple pay dividends, which are regular cash payments to shareholders. Now, let's talk about bonds. Unlike stocks, a bond isn't ownership. Instead, it's a loan you're making to a government or a company. They're borrowing money from you. In return for lending your money, they promise to pay you back a fixed amount of interest over a specific period. For example, you might buy a 10-year U.S. Treasury bond. This is essentially lending money to the U.S. government for 10 years, and they'll pay you interest, say around 4% per year, until the bond matures. So, how do stocks and bonds compare in terms of returns? Over the long term, stocks generally offer higher potential returns than bonds. Historically, the stock market has grown at an average rate of around 8 to 10% per year. But remember, that's just an average. Some years will be much higher and some will be lower or even negative. Bonds, on the other hand, offer more predictable but typically lower returns. A 10-year Treasury bond might pay around 4% interest, which is lower than the average stock market return, but it comes with significantly less risk. And that brings us to risk. Stocks are generally considered riskier than bonds. The value of a stock can fluctuate wildly based on market conditions, company performance, and even investor sentiment. Bonds are generally more stable, but they're not risk-free. Interest rate changes and inflation can impact their value. The ideal time to invest in stocks versus bonds depends on your individual circumstances, like your age, risk tolerance, and financial goals. Younger investors with a longer time horizon might be comfortable with a higher allocation to stocks, while older investors closer to retirement might prefer a more conservative approach with more bonds. That's where diversification comes in. Diversification simply means spreading your investments across different asset classes, like stocks and bonds. By combining stocks and bonds in your portfolio, you can potentially reduce your overall risk and improve your returns. Think of it this way. When stocks are down, bonds might be up, and vice versa. This can help cushion your portfolio during market downturns. So in summary, stocks offer the potential for higher growth, but come with higher risk, while bonds offer more stability, but typically lower returns. A smart portfolio uses both, balancing growth with stability. What's your current mix of stocks and bonds? Let us know in the comments below. We'd love to hear about your investment strategy. And if you found this video helpful, don't forget to subscribe for more investing breakdowns and follow us for weekly tips. Happy investing. Did you know we also offer a free newsletter packed with investing tips and insights straight to your inbox? Sign up now to stay informed and empowered on your investing journey. Finally, remember that investing is a journey. It takes patience, diligence, and constant learning. Whether you're just starting out or adjusting an existing portfolio, keep educating yourself and seeking advice from trusted sources. Here's to a prosperous future filled with wise investing choices. Thank you for joining us today, and may your financial journey be fruitful and rewarding. But remember, as much as we can plan, the markets can sometimes surprise us. It's important to stay flexible and ready to adapt. Use market news and updates as your guide, but don't let them dictate every move. Keep your goals in sight. Balance is key, not just in your investments, but in your approach. Enjoy the journey and remember to celebrate the small wins. Each step forward, big or small, takes you closer to your financial goals. Feel empowered by stories from fellow investors. Every story is unique, just like yours. Learn from others, share your experiences, and grow together in this ever-evolving world of investing. With every dawn comes a new opportunity. As you invest in your financial literacy, you also invest in the future you envision. Keep dreaming, keep learning, and may your efforts bring you abundance and joy.